every volatility is an invitation to invest.
I would say achieving 10% nominal GDP growth rate is not a difficult task. So the tariff has a more direct impact on small cap. That is why it underperformed for the last 18 months. I really think so that our earning trajectory will improve from here onward. Also the budget announcement and giving tax relief for data center investments and electronic manufacturing should have a multiplier effect onto the consumption. But definitely sooner or later you cannot ignore a country like with a 1.4 billion population and inherent domestic demand, and with fiscal consolidation and political stability. I think outlook for Indian equity market is positive.
And therefore, if you are having SIP, don't discontinue, don't stop, because India remains a growth story. Good evening, friends. Hope you are well and doing fine. I, Ashok Kanawala, on behalf of HDFC Mutual Fund, extend a warm welcome to all of you on this post-budget conversation and now also the trade deal. Before we get on to this topic, let me just dwell upon the volatility that is happening in the market. Volatility is the nature of equities. And what better way it can be explained with the events unfolding over last 3 days. On the day of budget, markets went down by 1,500 points. Yesterday, we had a smart rally up to 900 points. And today, with the trade deal announcement, market is up 2,000 points. So roughly, markets have not only recovered the losses happened on the budget day, but it has almost gained 100% of that. From a little bit shorter perspective, from what has been happening since September 24, markets are more or less at the same level that they were in September 24. But what we went through during those last 15-16 months is the impact of economic slowdown, thereafter the tariff threat, and thereafter Operation Sindoor, and of course what we saw on the day of budget. And despite all these events happening, we are more or less at the same level, and that's quite commendable. And extending further, so I've been in this capital market for more than 3 decades. When I started my career, the Sensex used to be less than 2,000, and today after 3 decades, we are nearly 85,000. So more or less up by 40 times. And during those 3 decades also, there have been periods of multiple volatilities for events arising for a variety of factors, and despite the markets are up nearly 40 times. So, in my opinion, basis my experience, every volatility for whatever XYZ reason is an invitation to invest, because India remains a growth story. And because of this growth story, inherently people create wealth by remaining invested in the markets, by remaining patient. And therefore, it is rightly said that market is a place where the wealth gets transferred from impatient to patient. And to make money in this market, you don't require intelligent quotient, you require emotional quotient, EQ. Anyway, getting back onto this topic, we have with us today Gopal Agrawal, needs no introduction, a veteran, a very senior fund manager with us, with more than 2 decades of experience of investment and research. Currently, he manages Balanced Advantage Fund, the first hybrid fund to cross 1 lakh crore of AUM. And besides that, he manages large and mid cap and dividend yield fund strategies also. Welcome, Gopal.
Thank you, Ashokji.
Coming to the topic, I know now trade deal has almost taken over the sentiment.
Yeah.
As far as markets are concerned. But let's start with the budget first. Your initial thought on how you look at this budget.
So a budget, in my view, for a stock market perspective, was really very pragmatic in number. So the numbers which were assumed both on revenue and expenditure side looks very, very reasonable. And also in this budget, there was a fear going into the budget that Capex can be curtailed, as we had reduced the GST going into this budget. But the government has really focused on Built India. So the Capex has been increased effectively 12.2 lakh crores of capital formation budget, which is very positive. And but on aggregate basis, it lacks major trigger for the market perspective. But it's a balance, but it lacks a trigger for a big rally in the market from the budget perspective.
So, in your understanding that because some excitement factor was missing, that's why, and of course the STT on FNO that was announced, was the main reason for markets to go down substantially on that day. Otherwise, directionally, the budget seems to be more or less in line with the policies of the government.
Absolutely. So the budget per se was very pragmatic, as I said. There is nothing negative to find out, because what we need from the government policy from the market perspective is continuous reform and employment creation and the investment on building the country. So there was revenue expenditure was reduced, capital expenditure was increased, and also assumptions on the tax collection was very reasonable, and fiscal deficit has also been reduced from 4.4% to 4.3%. So we are in a very glided path for fiscal consolidation. So definitely all these things are really very positive for the market. But what in general, going into the budget, people had certain expectation on reduction in capital gain tax, okay, to lure the FII investment into the country. So on that kind of things was not there, and generally nowadays budget has become more less and less important, because the majority of tax collection is action is taken through the GST council actually, right? So the government had already announced a GST reduction for the consumer sector on 15th of August and implemented from September 22nd. So in my view is that the budget was really quite good. So I'm hopeful that what the path the government has taken will really is a very structural positive for the Indian equity market perspective.
So, if we see the events of last 15-16 months, as I said earlier, and the action of the government as well as RBI. So, there was a tax incentive scheme to boost consumption in last budget. After that, there were GST reforms to boost demand further. Both have sort of played out. Now, you rightly said that the budget focuses on the Capex. So, what do you, in your opinion, is the roadmap ahead for the Capex? Or because Capex is a very important part of the sort of stocks that are listed on the stock exchange. So, what do you read into this budget going into Capex program? How the government has approached Capex, etc. Which sectors do you think within the Capex are likely to have a positive impact?
So in this budget, the government has focused a lot on electronic manufacturing, and also to the value chain of AI adoption in the world. So we have doubled our allocation for EMS scheme incentives. We have doubled it. Second, we have given a tax budget for data center and cloud adoption in India. So any foreigners who is putting up data center in India and using it, so they have given tax exemption till 2047. That is very positive. So that globally we know that more than $750 billion are being invested into the AI value chain every year. That has been the announcement by the big tech companies in US. So India is really a beneficiary of this, and to attract that investment in India, we have given this benefit. So this will have a very positive effect on entire value chain from data center developer, power backup, cooling equipment provider, then power generation, right, and then power backup. So definitely it will have a very large multiplier effect into the economy going forward, and boosting these electronic manufacturing definitely gives jobs for millions of youths in the country. So that is also very positive. So in a way, capital goods segment and value chain of power is going to be the direct beneficiary of the announcement of this budget.
So in a way, it's a structural shift from even within the Capex segment, that now India as a country is targeting a high end of the electronic segment, going into semiconductors, data centers, and with tax benefits going up to 2047. So that will boost real estate infrastructure also, and of course then the cloud system will take over, etc. So it's a very structural shift as far as country is concerned. Now coming to the budget overall, there projections, and because you have to start somewhere budget, that budget has a projection of say 10% nominal GDP growth. Do you think it's a fair assessment? Do you think that is given that in inflation scenario, given the real GDP, it's more or less achievable, or there are ifs and buts to it?
So, I would say achieving 10% nominal GDP growth rate is not a difficult task, because last year what we had a negative WPI. Now, as we know, like, the globally all the major countries are going for hoarding the critical resources in terms of minerals and all. So we have seen, manufacturing inflation is likely to go up as the commodity prices have bottomed and we are seeing it is increasing. So that will have its own impact on to the nominal GDP growth rate of the country. Second perspective is that the what we talk about, this structural thing like electronic manufacturing, data center, Capex, and then we are talking about the big impetus to logistics sector, and but definitely it will create more employment in India. So it will have its own impact on achieving the nominal GDP growth target of 10%. So I think I have really very less doubt of not achieving 10%, and the way globally things are playing out, I think nominal GDP growth rate can be on the higher side than this actually.
So if it actually exceeds 10%, it will help fiscally also, because in terms of higher tax collection, etc.
100%.
But there was a concern in the budget about the gross borrowing going up to 17 lakh crores, and of course there will be further borrowing from the state governments also. And yields did spike up a bit after the budget, and of course they have been rising, although interest rates in general have been reducing. In India, RBI has been reducing, but the market yields have been inching up. So what is your assessment going into this interest rate outlook? What do you think, that is this interest rate have the room to move lower or stay where, or it will be remain range bound, something like that?
So I would say this is very a great topic of discussion actually. What is happening, we have certain issues on deposit growth. Second, what we have seen, like FIA relentless selling in India, and and they also, the promoters are taking out money from the market. So net what is happening, our FDI, net FDI in the country is now turning closer to zero. Right, generally we used to have a 38 to 40 billion dollars of positive FDI figure, that which is because of the global trade tension and FII money taking out from the country. The net FDI is it has reduced, so which has an impact on the liquidity in the country itself. Then our deposits are lower. In this situation, if you have talking about gross borrowings are going to 17.2 lakh crores, and also in this the short term treasury bill of 1.3 trillion is included into this. So this will have some impact on the bond yield. The good news is that the announcement of overnight reducing tariff on India, this can change the equations to some extent possible, because even if the FPI's selling becomes zero, they may not be net buyer. I'm not forecasting. Even if the FII selling stops, so it will have a positive effect on on the liquidity in the country, and so the borrowing program we can meet very easily. So that is why you are seeing some minor rally today into the bond market, because but it's a long way to go, but I would say at the margin overnight announcement is positive for the bond yield actually.
Yeah, actually thinking this way that this deal addresses quite a few things as far as India is concerned for two reasons that 18% tariff rate is lower as compared to all the Asian economies, comparable Asian economies. So we compare Vietnam, Thailand, Malaysia, they all are at 19 to 20%. We are at 18%. So that is one thing is positive. And with US, we had a $41 billion surplus.
Yes.
Right? So if that gets restored to some extent, because last couple of months have been months of turmoil and turbulence because of this tariff deal not going in our favor at the initial stage, but now structurally going in our favor, that trade can reverse. So that means the FII flows or FDIs can resume and it can be structurally positive for the country. Now, coming to the behavior part of it, with you around and with your, we can't stop having 360-degree view of all the things that are happening in the capital market. So last couple of months, actually we saw lot of movement happening on the silver and gold side. Commodities have been sort of a darling of the market and lot of money, and suddenly something happened and in 2 days it corrected by 25 to 30%. And of course, time will say how it is working. What is your take on this silver and gold? Why, first of all, it went up also in a very frantic way? And what do you think is the reason for its correction and so sharp a correction? It's not that something. And is it worthwhile for investors to hold silver, gold in their portfolio in whichever way?
So, as we always, propose to have, very strict asset allocation in the portfolio, right? So, investors should diversify. So, in that the asset allocation from equity, precious metal, fixed income, real estate, these are all a part of this, and everybody based on their need and also risk profile to have a proper diversification amongst the all asset classes. So that is the requirement of the time. In the near term, what has happened starting from Russia-Ukraine war, the freezing of Russian assets by the global central bankers has led to a movement in the gold prices, and following that we are also seeing in the recent term the announcement by China to hoard the critical minerals, and also global tariff and money printing by US in the past is leading to this kind of frantic rally into the precious metal. I would give a word of caution here after such a massive rally. Generally, the commodities prices, especially silver, is trading at a price which is almost 5x of cost of production. Okay, so if you have any iota of information changes which will happen, so the price correction on the downside also can be very sharp. Right. So, if people want to hold in the portfolio, they can have very disciplined and maybe a part of their asset allocation strategy, but pure speculation based on cost of production and the selling price, there is a huge difference. So, so I would give a word of caution to the investor.
Maybe not with an idea of making immediate money, but more from the perspective of holding as a part of disciplined asset allocation.
Yes.
And anything can happen. Today equity can go up, tomorrow commodities can go up. Yes. Geopolitical tensions are still there. They are still persisting. Yes. It will have some its value in some store of value. Right. As far as gold and silver concerns accordingly. But coming between gold and gold, we always think this is store of value. When it comes to silver particularly, now what we keep hearing that of the because of the sort of a migration to renewable energies and EVs, etc., semiconductors for that matter, the use of commodities like silver, copper is on the structurally on the rise. Do you subscribe to that view?
I really subscribe to the view that copper is really a metal which is in structural short supply. Okay, as the resources of copper is getting depleted, and so definitely the only part is that because of global tariff related and trade tensions, the global growth itself is very muted. We are talking, World Bank is talking 3.3% world growth. We have seen a period of 5% world growth between 2003 to 2007. That era is not there. But anytime the demand for copper turns up very fast, I would say that is the metal can be in real short supply, because incremental supply is absolutely not there. So definitely that is where I will put more bet on, because that's a reality. But in terms of silver and all, I would really tell you, any supply disruption can only change the equation dramatically, right? So and it's a very short commodity of 35,000 tons of production and supply. So so any supply disruption or any logistical challenge can also create big price movement in the market.
But structurally, you can see some kind of their extreme additional uses going up, at least in the industry, in terms of semiconductors, in terms of
Ashokji, what has happened for the last couple of months, the behavior of China is also creating a lot of uncertainty in this market.
okay.
And second, investment demand is also going up very heavily. So apart from the normal demand growth, this the fight between the larger nations is also creating more impact on the silver price.
Now coming to one more commodity on which India is heavily dependent, because we import 80% of our oil requirement, and up till now we have been buying from Russia at a discounted prices, which was helping us in terms of meeting our current account deficit targets or whatever. And one of the key argument for imposing tariff that we are buying Russian oil. Now, since we'll stop buying Russian oil, that's what has come out in the trade deal. What do you think will be impact on the oil prices in general in the global arena, and how it can adversely affect us, if at all?
See, in general, what is happening, the global oil demand growth is less than 1 million barrel per day, and supply is increasing by over 2.5 million barrels. So market is in a structural oversupply actually,
Okay.
right? So that is there. And what we have observed that the Chinese oil demand growth has flattened actually. So because the EV adoption rate in China is very fast. So definitely oil market is less of a concern at this point of time. But definitely, if a large exporter like Russia if it is being disallowed to export, right? So definitely it will create a shock in the market, and the price can go up for short term. So, but what we are seeing, that China is regularly buying Russian oil very easily. So I think there will be buyer for Russian oil even if the India reduces to zero. So I don't think it will have a large impact, but definitely slight upward bias can be there if it becomes total zero by India actually.
So maybe our dependency on oil has been reducing over the years. So any kind of advice should be still
Should be
controlled.
manageable.
Yeah,
Should be manageable. It
Should
will
be
not
manageable.
hurt large extent to our current account deficit.
So now coming to the post-budget scenario, now as we said, the market fell, market again went up. Nifty is around 26,000. Markets are at Sensex at around 85,000. What is you think in terms of valuation? How are we placed? and where is the opportunity? If you really think this way, where is the opportunity? Which segment of the market? Which sector? Because budget also is out directionally. It also lays down where government wants to focus more. So we have budget also, and you have earnings outlook also before us. So small, mid, large, which sector? Where do you think is an opportunity for the investors?
So, very clearly at this juncture, the large cap still looks more favorable because the companies have very strong earning momentum as compared to a small cap at this point of time. But I would like to also say the small cap segment affects heavily because of tariff, because what has happened, to reduce the impact, the government reduces these GST for the consumption goods actually, and and to manage the fiscal deficit, we are reducing our capex in the last 4 months of this fiscal to balance the fiscal deficit to 4.4% in FY26. So we are seeing some moderation in investment. Most of the investment led companies are into small caps, and also gems and jewelry, textile, leathers, and all those goods or the companies
Labor intensive.
labor intensive are primarily into small cap, which impacted by tariff. So the tariff has a more direct impact on small cap. That is why it underperformed for the last 18 months. And if they've announced yesterday night, so if it is implemented in reality, definitely the pressure from small cap should go away, and we can see some relief rally into small cap also going forward
So
actually.
a couple of things like reduction in interest rates announced by RBI over the time,
Liquidity
plus budget,
injection.
also some MSMEs
Yeah.
provisions were there.
Absolutely.
And now with deal coming through also, the business prospect also improves.
Yes.
It is for labor intensive, so it should augur well for small cap. So one can look at small cap also
Very good.
in
Very
a
real.
staggered manner or whichever manner you can see
Absolutely.
it.
Absolutely.
But about the sectors, which is budget is also policy document and
Yes.
gives the direction in which government wants to move. Are there any pockets where you think they are likely more favorable? Like we had with GST card coming up, consumption was definitely one theme that was playing
That has
out and
played
will play out.
Yes.
So anything else that you think?
No, see, very clearly financialization theme in the country is continuously going to play out because India has a young population, and so definitely the older habits of savings in a different form, in terms of deposits and all. So Gen Z is moving more towards these financial markets like what we have seen in the developed market. So I am very positive on financialization theme in the country from the equity market perspective. Then, as I told you, the budget focuses a lot on directly, indirectly capital goods segment, and power value chain will be benefiting from the announcement in the budget, and that is also at a, I won't say it's a very cheap, but it's at a reasonable valuation relative to its own history. So that can be beneficial out of it, and also very clearly this budget is focusing on capital formation. If we really invest our full money into this, then cement is the one sector which has underperformed, can look up in the times to come.
Gopal, from a market perspective, if I really look at today, I don't see anything which is negative on the horizon.
Yes.
Whatever negatives were actually getting addressed, there were like a tariff, then also we recovered. There was a geopolitical tensions with us, with our neighbors also. That also we overcame. Still market continue. But what was maybe not in support of the market over last couple of quarters was the earnings growth.
Yes.
Single digit growth, which was, and therefore markets were looking a little bit more expansive as compared to other emerging markets, and therefore maybe FI interest was going in more in favor of the other geographies as compared to India. But as I understand that outlook of earnings going into 27, 28 are better than what they were for last 2 years. So what in your opinion has sort of changed which will drive earnings forward. Why should we? Because we always start good, but somehow the earnings disappoint. Do you think structurally we have entered a trajectory of double digit growth as far as earnings is concerned going into 27, 28?
I really think so that our earning trajectory will improve from here onward. There are a couple of reasons for that. One is that our nominal GDP growth rate will look better. We were at 8.7%, maybe 10 plus percent. We will be there in FY27, and it should continuously can go up as the globally, things are being settled after the initial announcement on the tariff and all, and now we are seeing a lot of trade deals are happening. So definitely things have bottomed out. Things are looking good. Add to this, in India, we have 150 basis point of rate cut has happened. RBI is doing continuously supporting the growth in terms of OMO and liquidity injection in the system. Lot of policy on this, on the banking sector side has been turned very favorable for lending purposes. And also what we are seeing today, the certain sector like autos, which is really benefiting from the lower GST rate, and then we have the impending pay commission is also there.
Yeah.
So which will also likely to boost the consumption going forward. And and also the budget announcement and giving tax relief for data center investments and electronic manufacturing should have a multiplier effect on to the consumption. So my sense is that and also this year we had a rate cut, steep rate cut, but deposits were not there in the bank. So we have seen some margin compression in the short run, but it will normalize over time. So you will see better trajectory of earnings even in financial sector, right? I really see that energy prices are under control. So users of energy will also be benefiting of this. So my strong sense is that the earnings have bottomed. It will recover gradually into the next 2 years. So the this announcement of tariff is also taking away the tail risk of the market. You are seeing lot of, negativity was there. What will happen to employment? What will happen to textile, leather, gems and jewelry, chemical sector, right? So now you are seeing those worry is getting behind, right? With the announcement of tariff. So it will have a positive rub off into the market going into the next 2 years. So the investor should have a patience approach, and and they should be disciplined in investing. My sense is that surely the worst of the earnings is behind us.
Very good. Now coming to this once again economy, and again I slightly go back to tariff. When tariff was announced and we read into a lot of projections that India will lose 0.5% of GDP growth only because of this tariff imposition. But when the numbers came out, it was actually other way, and we are growing at a very healthy pace. Even when we look at the current December high frequency data coming out in terms of credit growth, it is at 13-14%.
Yeah.
It never used to be like that. So your sense is that we have all the potential to grow in the 6.5 to 7% going into future with whatever sense that we are getting from the industry, from the businesses?
Yeah, because see, India is still a young country, right? We have the large young population, right? So definitely we have an inherent domestic demand. Despite the global trade is uncertain. So in India's context, growing closer to 6% plus is more or less given. And then you are seeing some policy support, like we reduce the GST for boosting the consumption, we reduce the interest rate, we injected liquidity in the system, banking system, as we discussed, has increased the credit growth to 13% plus. So we have all the measures, because India is a large country, right? We have a 1.4 billion population, we have a large domestic saving pool. So definitely 6.5% kind of growth is more or less easily achievable. But beyond that, we need some global tailwinds actually.
In short, if right ecosystem is established, then India can really benefit from this demographic and all, because India can be a producer as well as consumer. a very large producer as well as large consumer. We can make, as I said,
Yeah.
we can make an iPhone, we can consume iPhone.
iPhone.
Right.
Absolutely.
So coming back to the schemes that
Yeah.
you have been managing, and on Feb 1, Balanced Advantage Fund has completed 32 years of stellar track record. And of course, compliments to them. You have been managing this for nearly last 5 years. I'm sure the investors have been benefited. So, what's your first word on Balanced Advantage Fund? Because now a lot of new investors are joining the industry every month. Lakhs of investors are coming in. We were at 2 crore investors on March 20. Today we are nearly 6 crores. So every month, lots and lots of investors are getting it. Mutual fund is becoming a really popular product. So, what is your first message to this, and what people can really expect from Balanced Advantage Fund?
The way we manage in HDFC mutual fund, we have a dynamic mix of equity, REIT InvITs and fixed income, so and arbitrage. So four things we put in together to manage the risk on the downside and give moderate return to the investor. That is how we are constructing this portfolio. And if you see, we have a stellar track record of dividend in this fund, and the way we have dynamically managed it, I just want to give you, in August September 2024 we were at 62% of equity. We brought it down to 49%, and so it was a very timely reduction of equity allocation in the fund. And then during March April 2025, when the market has corrected handsomely, we went back to closer to 59%, right? So we have dynamically managed it. And in the recent correction, again, in my view, that market level become attractive, we increase further allocation to equity, so that so this dynamic allocation has worked in the past, and I hopefully it should work in future.
Basically, you take care of the asset allocation dynamically by moving equity up and down.
Absolutely.
Now, with this budget, with this trade deals, how do you think is the portfolio composition wise positioned?
So the portfolio is positioned well to take benefit of both local and global opportunity. So what we have done, let's say we are focusing, as this fund is generally quite a little conservative in nature, because we have lots of retirees in this fund. So I have focused a lot on cash generating businesses which will benefit over time. So this and we have taken that is there. And then what we have done, we have added over time lot of consumer stocks also, so that because India is a young population, we have a structural long term growth story on consumption and also financialization of assets. So we have added both in the fund. So that is also there, and also we have a decent exposure to capital good and infra, which will benefit from the government policies.
Good. And coming to another strategy of yours, large and mid cap, another big strategy, more than 25,000 crores of AUM, and it has I think mix of 35% each, large cap and mid cap, and balance 30% can be swinging.
Sure.
So how that portfolio is positioned, and what do you expect out of that, given that mid cap valuation, etc.?
So that fund is primarily for aggressive equity investor, those who want to invest into the market for long term. And in my personal view, that large and mid cap is the, as a fund manager, I would say it is the best strategy for a long term investor to invest if you are a risk taker, because what happened in, if you see the market for the last 10 years, 15 years return, the mid cap has given you the highest return, and then you get the stability of large cap. So generally I manage between 44 to 50% large cap, 35 to 38% mid cap, and I keep around 9 to 14% depending on time into a small cap. So so this fund is a good combination of all. into a single product. And if you see, so you get in the volatile time, you get the stability of large cap, and then in the growth time you have a upward bias from mid cap and the small cap. So this is, I would really bet on this product a lot. As a fund manager, though I may be biased, but I would say this is an ideal equity product for a risk taker for long term.
Okay. And then final one more strategy is that dividend yield, rather small strategy, with markets at current valuation. Where is the opportunity there?
So the dividend yield per se, this strategy is more conservative in nature. So in this we invest primarily into the profit making and dividend paying companies actually, right? So it's a more predictable businesses which we buy. So my sense is that this strategy is good for long term investment with a moderate return expectation, because what happens, there will be period of very high return and there will be period of moderate return, but in general over time it balances out actually. So the way we manage it, we have a good balance of IT sector which gives very high dividend. Then we have a good FMCG company, also they pay good dividend. Then I have public sector enterprise, and to make it more market friendly, I have some small caps also.
So going into that 25, and we had a lot of concerns which were apparent on the face of it, and suddenly, of course, starting this year, we had this geopolitical tension happening sometime, and suddenly on today morning, everything seems to have vanished. So nothing like, as I said, that looks like a risky proposition right now, and like a Maidan is clear type. But according to you, what could be still a key risk from a investment perspective, and if at all, with what kind of expectation investors should attempt to invest in this market with full understanding?
So I would like to highlight some of the risk in this market. One is that at this point of time, most of the global markets are trading at new high, okay, or 52-week high.
Okay.
Right. So the there is a lot of investment towards the AI, and everybody is talking about the big impact of AI, right? And if the profitability from the AI investment is not coming the way it was expected, then there can be some correction to the global market, right? So it can have some fallout on Indian equities also. That is one. Second point is that too much speculation in commodity can also create some kind of turbulence if there is a drawdown into that asset class also, right? That is another. Third is that the world is becoming more volatile, jingoist in the last 5-10 years. So definitely, that can have its own impact on the market. But I would say, market is trying to take its own stride. So it will have some knee-jerk reaction, but it won't have a very large meaningful impact on the market. But the real thing now, as we have already cut the interest rate, we have injected the liquidity, we have given very decent budget in terms of fiscal consolidation. Now the key for the market is the earning growth, right? So we will make returns in line with earning growth, right? So no more room for P expansion so easily, right? So the earning growth is the key. If any, so our market is trading at closer to 22 P multiple on the forward. So now we need to get earning growth higher than nominal GDP growth rate.
Okay.
So now there is no excuse. So why you are seeing the index is at the same level, but median stocks are down by 20% in the last 1 year, because if the higher P multiple stocks are not getting earnings higher than nominal GDP growth rate, then it's a case of disaster. So my biggest risk is earning. Rest is all, can be very temporary.
So earnings growth is what you should be watching, and hopefully double digit should resume from FY27, and that should support the markets going into. Final question before we can end this call is what is the key message to the investors, our audience today on this call, what they should be going into CY26, how they should be investing, where they should be investing, and what should be their expectations in line with whatever we are sort of projecting?
I would really say that, one should have a proper asset allocation, because what is happening, we are seeing some hardening in bond yields also, because of near term FI selling and its impact onto the deposits and these the government borrowings. So over time people should have some allocation to fixed income also, so that they can benefit in future. And in equity, I am very constructive, because what I would say, India, we don't have major risk at this point of time. Macros are very much under control. Only thing is that if the earning growth, where we are reasonably confident that we should see upward trajectory on earning, so that they should have continuous allocation to equity, but they should tone down their return expectation. As we are discussing nominal GDP growth rate of 10%, last year it was even lower than this. So, generally over long run, the equity returns have coincided with the nominal GDP growth rate, where the earning growths are, right? So investors should reduce their expectation for the future return. And in terms of precious metal and all, I would really say one should be very cautious, and they should only allocate to based on their risk profile and to what it goes into their asset allocation, because it has really given very high return in the last 2 years. So where so one should not chase the momentum. Chasing momentum has never worked. So be disciplined, and India has a long-term growth potential, and we are really in a right direction. So whenever the FII investors and all are slightly ignoring India at this point of time, because they are seeing AI and other thing, but definitely sooner or later you cannot ignore a country like with a 1.4 billion population and inherent domestic demand, and with fiscal consolidation and political stability. I think outlook for Indian equity market is positive.
And therefore, if you are having SIP, running SIP, don't discontinue, don't stop, continue, because India remains a growth story.
Absolutely.
And there will be intermittent days of extreme volatility, and those SIP will help you actually average out your rupee cost averaging, and will help you to maybe earn better than the nominal GDP, because whenever the volatility is happening, you invest, actually you have the volatility has actually have turned in your favor, and that's what we have seen in last 2-3 days. That's what we have seen last 15-16 months, and that's what we have seen over the decades. Also.
You said it well, actually.
Absolutely. So it's like, I always believe that equity investing like visiting a seashore. If you have a low tide, you have a high tide. Low tide, people go very close to the sea, deep inside the sea, and suddenly high tides appears and you get washed away.
Absolutely.
And that's how, when things are very clearer, etc., you start jumping, you start chasing momentum, you don't make money.
Never.
Right? So always be on a shore side, keeping a safe distance, and enjoy the ocean. It's like that. And that's how you create the wealth. Yeah. So thank you, Gopal, for being in this call. There have been some questions. Let me see if I can take some. The way your portfolio is structured, you play around or invest in quite a larger number of companies. That's what the question is all about. How do you really manage those companies, and how this your skills over the last 2 decades of your experience is actually helping you manage this kind of investment management?
See, very clearly, though this is not my mandate, but I am always benchmarked against an index in terms of performance. But my personal belief is that I should try to generate absolute positive return. So I try to buy the stock, which are available at a very reasonable valuation in terms of my thinking and with the help of our research team. So I tend to buy more number of stocks if they are available at a reasonable valuation. And like many fund managers, they believe in their style of finding a long term compounder or want to have limited holding and they want to go with it. But my view is that if the asset is available at a reasonable valuation where downside is limited and every business has its own cycle. So I believe over time we will make return out of it where downside is limited. So I just buy it. So that is why I have more number of stocks.
Okay. Finally, one asset class that we missed out, there was a question here, is on the currency. And last couple of months, rupee has steadily depreciated against major global currencies, be it pound, be it dollar, be it euro. What do you think from a current level? How do you think this currency should be? Although we are not an FX expert,
Yes.
let me put a disclaimer right away.
I tell you, as a market participant, what I really believe, current rupee depreciation is more to do with the flows, not to do with the fundamentals.
Yeah.
So if you are seeing regular FII outflow from the country, right? So though you know that the good news is that we have the highest forex reserve at this point of time. We have crossed $700 billion.
Right.
So, and we have a very current account deficit. Everything is under control. So what explains this rupee depreciation is definitely the flow related issues. So once the outflow is stopped, it will have its own
A lot to do with trade deal.
Lot to do with trade deal. That is why you are seeing today rupee is appreciating by over 1% today, right? So that is why I am saying that currency depreciation has lot to do with the flow related issue rather than a fundamental issue.
So trade deal has happened and budget is also out, and now it's all up to the earnings, how it is playing out, and how people sitting out of US who are always willing to look at investment outside their own country, and with data center etc. coming up, and we already have iPhone here working and more people may come up. So things looks promising from that perspective.
Absolutely.
So thank you, Gopal, for being on the call.
Thank you.
And thank you, viewers, for being on the call. Have a great year ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.